Hello, everyone, and welcome. Today, we're going to dive deep into a really fundamental concept in accounting. What happens when a business makes a significant purchase? Now, I'm not talking about buying paper clips or coffee for the break room. I mean a major investment, something that's going to serve the company for years. It sounds straightforward, right? You buy something, you own it. But how a company actually records and tracks this purchase over time is absolutely crucial for understanding its true financial health. So, let's get started. So this is really the core question we're tackling today. Imagine a company buys a new delivery truck, or a powerful server, or a critical piece of manufacturing equipment. How do they get that onto the books correctly? You see, you can't just treat it like a regular monthly expense, because that truck is going to be creating value for 5, maybe 10 years. This is exactly the kind of puzzle that accounting is designed to solve. And it does so with a very logical, step-by-step approach that we're going to walk through together. All right, so the journey of any long-term asset, whether it's a building or a laptop, begins at one specific moment in time, the moment of purchase. This first step, what we call recording the acquisition, is so important because it sets the bedrock for everything that comes after. If you get this initial entry wrong, it can ripple through your financial statements for years. So we have to get it right from the very beginning. Okay, before we go any further, let's make sure we're all on the same page with our key term, a long-term asset. The definition is right there, but let's break it down. The key idea is that the company buys this thing to use it, to help run the business, not to flip it and sell it to a customer. And the second part is just as important. It's going to provide value for more than one accounting period, more than 1 year. So for our discussion today, let's use a simple, concrete example. A small business buys a new high-end computer for $5,000. This is a perfect example of a long-term asset. Okay, so we've bought the computer, it's out of the box and sitting on the desk. The next, and perhaps most important question is, what is it worth? I mean, what value do we actually put down in the company's official financial records? Accounting has a very clear, very firm rule for this, and it's a principle designed to keep everything as objective and consistent as possible. And that rule is the historical cost principle. Now, this is a big one, so let it sink in. The asset, our $5,000 computer, is put on the books for exactly what we paid for it. Not what we think it's worth, not what we could sell it for on eBay tomorrow. It's recorded at the actual, verifiable transaction price from the invoice. This principle provides a solid, objective anchor that we can always refer back to. Now, you might be thinking, well, why not just use the market value? Isn't that more accurate? And that's a fair question. But look at this comparison. Historical cost is objective. We have a receipt. It's verifiable. Anyone can look at the invoice and agree on the number. Market value, on the other hand, well, it's subjective. Whose opinion of the value do we use? It changes day to day, even hour to hour. It's much, much harder to prove. By sticking with historical cost, we remove all that guesswork, ensuring the financial statements are reliable and can be compared from 1 year to the next. So our computer is officially on the books at its $5,000 cost. We're all good. But we all know how this story goes, right? A year from now, that computer is not going to be worth $5,000. Technology moves on, parts wear out. It's just reality. So how does accounting handle this inevitable decline in value? Well, it uses a core concept called depreciation. Now, I want you to look very closely at this definition. The most important word on this slide is allocating. Depreciation is not a process of trying to guess the asset's market value each year. It's a systematic way of taking that initial cost and spreading it out over the time the asset is expected to be useful. Think of it this way. We're matching the cost of the computer to the periods where the computer is helping us earn revenue. It is purely an allocation process, not a valuation process. That's a distinction that trips up a lot of students, but it's crucial. Okay, so the theory makes sense. We need to allocate the cost. But how do we actually do it? How do we calculate the numbers? Well, there are a few different methods, but the most common, the most widely used, is called the straight line method. And honestly, it does exactly what its name suggests. It spreads the cost out in a perfectly straight, even line over the asset's life. And the process is beautifully simple. It's really just a 3-step dance. Step 1, we start with the asset's cost. We already know that thanks to the historical cost principle. It's $5,000. Step 2, the business needs to make a reasonable estimate of the asset's useful life. How long do we expect to use this computer before we need to replace it? For a piece of tech like this, 5 years is a pretty common estimate. And finally, step 3, we just do the math. You take the cost and divide it by the useful life. $5,000 divided by 5 years? And there's our magic number,
$1,000. This is the annual depreciation expense. This means that for each of the next 5 years, the company will record $1,000 as an expense on its income statement. This is how the business formally recognizes that a piece of the computer's value was used up that year. And from a decision-making standpoint, this is huge. This $1,000 expense, even though no cash is leaving the company, reduces the company's reported profit, which in turn reduces its taxable income.
Now, this table, this really pulls the entire story together. Let's walk through it. At the end of year 1, we record $1,000 of depreciation. The accumulated depreciation is now $1,000, and the computer's book value drops to $4,000. The book value is simply the original cost minus all the depreciation we've taken so far. In year 2, we do it again. We add another $1,000. The accumulated amount is now $2,000, and the book value falls to $3,000. You can see the pattern. We just repeat this until, at the end of year 5, the book value is 0. A manager looking at this can clearly see the asset's value declining on the books and can start planning ahead for its replacement.
So let's zoom out for a moment. What was the whole point of this exercise? Why go through all this trouble? It all comes back to one of the most important ideas in all of accounting, the matching principle. By spreading that $5,000 cost over 5 years, we are correctly matching the expense with the revenues that the computer helped generate during those years. Imagine if we didn't do this. The company would look like it had a huge expense in year 1, making it seem unprofitable, and then it would look artificially profitable for the next 4 years. This method, it gives a much truer picture of the company's performance over time.
And that leads us to our final question for today, and it's a really interesting one that bridges the gap between accounting rules and business reality. At the end of year 5, our computer has a book value of 0. On paper, it's worthless. But what if it's still running perfectly? What if it's still a critical tool for an employee every single day? This really highlights the fact that book value is an accounting construct. It's for cost allocation. It is not a measure of an asset's real-world usefulness or its market price. And understanding that difference, that's what separates a good bookkeeper from a smart business decision maker.